Welcome to Inside Networks in Briefs at the Income and Defensive Asset Symposium. My guest today is Tiki from Ares Management. Welcome, Tiki.
Hi, Jamie. Thank you. Thanks for having me.
No problem. Can you provide some background on Ares and its global operations?
Yeah, sure. So Ares is a global alternative asset manager with about $325 billion of assets under management. And we manage assets across credit, private equity, real assets, secondary solutions and strategic initiatives. But of that $325 billion, really $197 billion is within credit across, private and liquid credit.
And tell us about the premise of your fund called the Global Credit Income Strategy.
Yeah, sure. So the Global Credit Income Fund was created to act as a yield enhancer and diversifier for Australian investors' portfolios. It focuses mainly on the tradable part of the credit market, so syndicated loans, high yield bonds, CLOs, and really is focused on delivering higher yield and diversification, but with a strong focus on downside protection. So there's at least 50% investment grade. We make sure we really focus on downside protection by avoiding losers and avoiding defaults.
And it's global.
It is global. It focuses on the US and the European markets because they are the largest and most liquid markets.
Yes.
And really is trying to anchor itself in high levels of current income, floating rate strategy, so pretty low duration. And it's really a pure play on the credit market and really is trying to bring back income into fixed income.
And how does Ares source their opportunities?
So Ares is one of the largest global credit manager. We started in 1997 in syndicated loans and high yield bonds. So we've been around for a very, very long time. We've got one of the largest platform in the space. We also started doing self-originated direct lending in 2004, and we're probably the largest non-bank direct lender in the world. So that gives us a very large funnel in terms of sourcing opportunities across the liquid and illiquid part of the market.
So you're saying that scale really matters in credit markets?
Yeah, I think it's absolutely key. It's one of those asset classes where scale, we believe, is your friend. Because going back to that funnel, if you have the largest funnel possible to look at as many opportunities as possible, you can allow yourself to be incredibly selective. If you see only a few deals every year, you're going to persuade yourself that these are good deals. But if you see thousands and thousands and thousands of deals, you can actually only select the top of the top. And that's really key for the way we do things. We rely on that very large scale. Now, the other thing that's important with the scale is actually integrating the various parts of the business so that we get differentiated insights. So, when our direct lending team talks to companies, when our private equity team talks to their private equities to their companies, we get differentiated insights, and that makes us better investors.
Great. And within the fund, how many individual lines is there? How many investments typically would be within the credit fund?
So in the Global Credit Income Fund, we have about 225 issuers, call it 230 issuers.
Yes.
And they're spread across geography, so US and Europe. They're also quite diversified in terms of industry. And so that's the other benefit of a fund like this one, is that you're not going to see the same thing as you usually see in traditional income strategy in Australian portfolios. So there is no Australian exposure. There is no exposure to RMBS. There are no exposure to banks. So it really helps investors access higher yields, floating rate mostly, so very low duration, but also from an industry standpoint, a true diversification to what they already have in their portfolios.
Now, we've seen bond markets whip around in the last 6 or 9 months like we haven't seen before. Is there a time that your fund could add duration? Or is it always going to be a combination of, always going to be mainly floating vehicles? No,
so the fund is able to go into fixed rate assets, which effectively add duration to the portfolio. So at the moment, what we're seeing, especially in the high yield bond market, for instance, where we've actually been, not investing heavily in that market, more focusing on the floating rate part of the environment, we are starting to see significant dislocation and discounts on credit securities that we haven't seen since the GFC.
Is that right?
So basically what you're seeing is that convexity is back in those credit market. And very simply put, convexity is what? Is the fact that you've got a credit instrument that's worth 100, it has a nominal value, has a maturity. So if it doesn't default, in 3, 4, 5 years, you get $100.
Yeah.
But right here, right now, you can buy it at 90 cents on the dollar or 85 cents on the dollar.
Yeah, well.
And so you've got a 10 to 15% potential capital gain on a security that's paying 6% on the $100. So it's a very compelling opportunity set, and we've started to actually rotate the portfolio to take advantage of that.
So active and skill is really important in this type of market versus the market we saw where rates just kept going down and down and down.
I think it's exactly right, but you have to remember that we are not a rates manager.
Yeah.
What we are trying to do is isolate the credit, the benefit of being invested in credit. So this is a pure play on credit.
Yep.
And the relative value we're going to be looking at is based on the credit view. And does it mean that we want more high yield bonds or more leverage loans or more CLOs or more investment grade bonds? That's going to depend on the relative value from a credit standpoint.
Got it.
So our duration in the fund is going to be, it's going to be between 1 and 2 years. So,
Yes.
so for asset allocators, it's actually kind of a sleep at night sort of things. They know what they're getting.
Got it.
They're getting a credit fund
Yep.
with one of the largest global credit managers.
200 names underneath. So
That's right.
Thanks very much for joining us.
Thank you very much.
Cheers.